What's up, guys? Back with another video, coming back to back-to-back filming. So let's get into it. We're back with part 2 of insurance. So let's go with the types of insurance. Let me name them out for you. Life insurance. Okay, life insurance is on your life. Let's go. Like I said, you cannot take it out on anybody else's life. So you have term life, whole life. So term life is when the insured is covered by the policy when it's in effect, usually 10 to 20 years. So the thing with term life, like, so I'm not going to dabble into this. I'm not selling anything. But term life, basically, it has no cash value. Term life can't borrow against any cash value because it doesn't build anything. It's just covering you. So it's saying, like, say if you die, boom, death benefit, there you go, term life. It's only for that certain period of time. Now, whole life, it allows the policyholder to borrow against the policy's cash value, because when you're putting money in, obviously it's called whole life for a reason. You're having a cash value build up, and then you can borrow against it, and when the term expires, you get the cash value of the policy. Now, mind you, sometimes, or most of the time, whole life insurance is probably for your whole life, obviously, or I believe it's somewhere around to 100 or 99 or 120, something like that, many years. But obviously, you're going to be old and wretched or something like that. So whole life insurance allows you to build cash value in it. Term life is just to say, boom, if I die, if something bad happens, oh well, go ahead and just kick out the death benefit, and that's how we do it. Whole life, you build a cash value. So if you want to take out some money against it, you can borrow against the policies of cash value. Obviously, there are more parameters into that, but that is the basics of that. So whenever somebody's coming to you with whole life or term life, that's how you differentiate between them. Now we have universal life, which is both a term portion and a savings portion, excuse me. So term plus whole life. And then your annuities, when you add an annuity to that, it pays a benefit to the insured until death to cover retirement years. So it's like a pension in a way. I won't get into too much of that, but that's the basics you need to know off it. If you guys want to know more, just let me know. So let's talk about life insurance companies. So I have my notes here. And life insurance companies derive funds from two sources. They receive your premium. Like I said, if you're more susceptible to risk, you have a high premium. As simple as that. You cannot drive down your premium, because if you have a lot of accidents, if you're prone to a lot of things, you cannot drive it down. And they receive the premiums that are used to pay out future claims when the insured dies. So remember, in a way, you feel like you're wasting your money on insurance, but at the same time, it helps pays out. And obviously, like I said, they need a lot of people to cover that. That's why insurance companies are billion-dollar companies, multi-hundreds of million-dollar companies, because they have the money to pay it out, because they have a lot of people. Everybody needs insurance. You got to cover things. If there was no insurance in the world, a lot of us would just be sitting at a loss right now with what we have. So they also receive premiums paid into pension funds managed by the life insurance company. So let's talk about life insurance company asset distribution. Now, these are from 2021. These are the numbers. Obviously, things can change. It's 2023. But usually a life insurance company, when their policy, their asset distribution usually is 50% bonds. Now, as we know, and as I talked about, bonds are very safe, especially U.S. Treasury bonds backed by the full faith of the U.S. government. Bonds, and then you have stocks. Now, stocks are more volatile. Usually want to have appreciation on it, capital appreciation. Miscellaneous, so it could be a lot of different things tied into that. Miscellaneous could be maybe you want to do indexes, etc. Loans and mortgages is about 9%. Mind you, this is 2021, fall 2021 stats, so obviously things can change between now and then. However, loans and mortgages, having that inside the asset distribution, has declined since the 1970s. So life insurance primary liabilities are their payouts and their pension funds payouts, and health insurance. Let's talk about health insurance. So whenever you get health insurance, there's vulnerability due to the adverse selection problem, because as I said before in the last video, people that are most likely to have something bad to them, that's what happens when people select them and say, well, we need them. Because obviously nobody's perfect. Then it's vulnerable because, well, what if somebody decides to go ahead and kill themselves, or somebody decides to go ahead and keep smoking or drinking, and you know they're susceptible to dying soon. That's the vulnerability to health insurance companies, is that, well, if we put this money on somebody and they go ahead and take out $1 million and say, well, I pay this, and then the whole entire policy gets turned upside down because something bad happens to them, and maybe they planned it out and they maxed that. So when they mask it, the insurance company says, okay, yeah, you're good. But at the same time, that's how people commit fraud in a way. But sometimes you may say it's not fraud. Technically, it kind of is, but I'm not going to delve into that. No arguments around here. Let's just say that some people do have a plan set in place and is vulnerable to adverse selection, which occurs before the fact. Now, individual policies must be priced assuming adverse selection. This is where insurance companies rebound themselves. So yes, it's vulnerable, but at the same time, the policies must be priced when they understand how you are. So they understand that you may smoke, you may drink, You may have a issue that involves you getting into accidents a lot. You may have a disability, etc. Like I said, that all ties into getting health insurance. No matter what, they have to account for every single thing. Otherwise, they're gonna have to have a lower premium, and then you'll be getting away with a lot. But at the same time, that is the insurance companies overseeing. That's their policy. That's their fault if they get into something wrong, because they are responsible. That's their responsibility. So most health insurance is offered through group policy. So you may have something at work where you have a group policy where the employer can cover you all. You guys get a certificate and say, hey, I'm covered by Blue Cross Blue Shield, etc., etc. I have that at work for me. And it says health maintenance organizations are another attempt to keep costs down, HMOs. Not going to get too much into that because that's a whole nother topic for another day if I want to do it. But let's just say the main thing about health insurance you have to understand is that you are priced out by adverse selection. So whatever you do right now, you might want to go ahead and stop it, get healthy, etc. Now I know people have addictions, all that. I'm not going to get into that, but all I can say is that if you're a healthy person, or you say you're a healthy person, just make sure that you don't have anything adverse happening to the point where the insurance company can say, well, we're going to raise your premium because of X, Y, and Z. Just remember that. Property and casualty insurance. So property insurance protects businesses and owners from the risk associated with ownership. You have two things you call open peril and named peril. So named peril policies insures against any losses only from perils specifically insured in the policy. So named peril means that anything that's named in the policy, you will be insured by, you will be covered by for property insurance. Now, open peril policies for property insurance insures against losses except from policies specifically, except from perils specifically named in the policy. So named peril, you're specifically only having those in the policy covered. Open peril, anything else that's not in the policy. So anything outside the policy, you're good with. Casualty insurance protects against financial losses because of a claim of negligence. So whenever something bad happens, you have a casualty from negligence, you are protected by casualty insurance. Now, reinsurance allocates a portion of the risk to another company in exchange for a portion of the premium. So whenever a company says, well, we don't want to take 100% for this person, reinsurance, a portion of the risk is going to be thrown to another company so they can obviously spread out the risk in exchange for a portion of the premium. That's how insurance companies keep going in loops and loops and loops by getting you, because some people say, I'm not putting 100% on this person. They are very adverse. They have a lot of things happening to them. So what are they going to do? Spread it to another person. Spread it to another person. So that way everybody can have their own portion. It lowers the risk for one company, and in turn, they get a portion of the premium. So that's how you do it. Exchange for something. Now, the government will pay 90% of losses to firms up to $100 billion in case of future terrorist attacks. That is some information we got from fall 2021 statistics back in Finance 470. 90% of losses to firms in case, or up to $100 billion, $100 billion, may have changed, may have went down, may have went up, in case of future terrorist attacks. So most insurance regulations are at the state level as well. And we're going to get into pension plans now because I said I was going to get into that. So pension plans. Obviously, when you retire, then you're going to have to get a pension maybe, or you get a payout weekly or monthly, however many times they want to put you on the payroll for that. But pensions, it's an asset pool that accumulates over an individual's working years. Remember, you have to work a certain amount of years in some companies, maybe 30 years, etc., before you have to get that pension, and it's paid out during the non-working years. So basically, once you work a certain X amount number of years for a company, then they pay you out saying, thank you, here you go, we're going to go ahead and pay for you for the rest of your non-working years. Now, you have a lot of pension plans, so I'm going to get into them, make it quick, but I'm going to explain them simply. Defined benefit pension is when the sponsor, so the person of that pension plan, promises the employee a specific benefit when they retire. Now, you have a lot of things. You have three types of funded. You have fully funded, overfunded, and underfunded. So fully funded, sufficient funds are available to meet the payouts. So fully funded, you're good, you get your whole max payout. Overfunded is when the funds are greater than the payout. Underfunded are when the funds aren't expected to meet the required benefit payouts. Now, it depends how many years you work there, but that is defined benefit pension, is when they promise a specific benefit to you. So whatever job you're at right now, if you want to make that your career and say, I'm going to work it for the rest of my life, understand if you have a pension or not. Now, if you work for the government, you got a pension. That's how it goes. Defined contribution plan. Now, I don't know if every single government entity has that, but for the most part, I know that you work in the military, you get a pension a certain amount of years. Work at the post office, you get a pension a certain amount of years. So, defined contribution plan is when the amount is invested for retirement, but benefit payout is uncertain. So defined contribution. So you invest a lot of money. It's invest for your retirement, however many years you work, etc. But the benefit payout is uncertain. They don't tell you a defined benefit. They tell you defined contribution. So you can pay this out, but at the same time, they don't know what you're going to get in your non-working years. So that's the uncertainty level. Do you want to have a contribution plan or want to have a defined benefit plan? Now, private pension is when employer, group, or individual sets up for their pension. So private pension comes from private things, private entities. If you want to have a private pension plan, one employer can set it up, a group can set it up. I don't know too much about that, but that is the base definition of that. Sorry guys for that one. But private pension plans, your employer, your group, or you as an individual, you can set that up as a pension. Public pension is a plan set up by the government body for the general public. So you have a public pension plan from you, the government, then that's what happens. Social Security. Everybody knows about SS, Social Security. It pay as you go. Current benefits paid by current funding. So you get Social Security when you're in your, I believe, your 60s, I believe. So please don't quote me on that. Like I said, I'm not trying to give misinformation, but let's just say when you're past 50, when you're past half a century, you're supposed to get your Social Security. Unless I think there's early payouts, something like that, but I gotta go check that again. I haven't read my book in a while. But let's talk about IRSA, or the Employment Retirement Income Security Act of 1974. So it established pension funding guidelines. Department of Labor oversees it, so you don't have to worry about anything. And your vesting requirements is to gain plan benefits, but it's established as a pension guarantee corp to guarantee pensions if underfunded. So basically, it established guarantee corporations or guarantee corp to guarantee your pensions if it's underfunded, which is underfunded means the funds aren't expected to meet the required benefit payout. So you were saying, I won't make enough to afford my house, or I won't make enough to afford this and that. You have the IRSA Act of 1974. It can help you. Talk to your employer about it, or if you want to talk to the government about it, go ahead and talk to the Department of Labor, put an inquiry in. But all we need to understand basically is from the pension plans is that wherever you work at, understand what you are able to get from there. Because if you don't understand what pension plan you have, then you're going to be having the defined contribution type mindset, whereas that you don't know your certainty of your pension. So guys, thank you for listening. Sorry it was a whole hassle. Pensions, I definitely have to get more research in on this. But as for insurance, just understand, get your research done. If you don't get it done, you're going to be failing. You're going to be lacking. Insurance companies will go over you. So guys, thank you so much for watching. If you have any comments, let me know. And thank you. Tune in for next.